Welcome to Investors Hangout. This fortnightly interaction to help you learn more about saving and investing is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today we're going to be talking about 10 bad money habits that investors need to give up. And with me to discuss this is Dhirendra Kumar, the CEO of Value Research. Welcome, Dhiren.
Thank you. Thank you, Rachel.
Now, Dhiren, before we jump to discussing these financial habits, I'd like to first get your view on why it's so important to identify and kick these habits, even though we seem to be getting on, just fine despite them.
After many years of answering people's question, trying to understand their problem, the kind of problem which gets created, even well-off people, people who actually make a good living, earn well, work hard for a life, and eventually they may not have enough or not adequate enough. Most of the time, I find that at the root of the problem often lies in doing some mistake which cannot be fixed later on. For example, and that's the case in most other faculties as well. You can go about having a nice treatment for an ailment, but if having a good healthy lifestyle is a fundamental to it, and likewise there is a need for a good healthy financial habits, if you and investing, given that everybody has an incentive to go about doing their making a sale, going about selling their stuff which they like, and they are being incentivized to act in their best interest. So somebody will get after your life to and make a case for something, and if you do not apply your mind, or if you don't have clarity of thought in terms of what it is all about, because personal finance is pretty straightforward. And some of these mistakes which people do, it cannot be undone. For example, when you go to a place, you go to a shop and you are tempted, you are looking at something, and it may not be a necessity, but the availability of easy credit, that itself creates a problem. Or you start your job and you start making you start earning, and then you are faced with you are presented with a credit card, and that entitles you to easy credit anywhere. And then the credit card company's interest in lies in making sure that you carry on you don't pay all of it, so that they can charge you interest, and that actually incentivizes people, so that you have the convenience, money being made available, and our need or desire to actually have something before we have the money, that creates a lot of problem. So investing and savings, investment, and personal finance is all about, I think it is more about not doing a lot of things than about doing the right thing.
What are the most common financial habits that you've come across among people and among investors?
At the very basement, it is all about not saving. Everybody is done with his income, consuming his income by 25th, and either borrowing. So that one is not saving, not fitting into that. That's one. Not having the comprehension that we are going to be working and earning for limited number of years, and that money, that saving and investment itself has to take care for the period when you will not work. And this comprehension actually, because we are very confident while we are working, we are relatively young, we think that that is many years away. We procrastination. So there are many things, but if I have to list things, one is easy credit. You go to a place, you look for something which you may not necessarily need, but you easy EMI loan available, and you go about doing it. Spending without saving. So it's one and the same thing.
Right.
I'm not saying that one should not borrow. One should borrow. One should borrow, definitely borrow for emergencies. If a situation you land into, one should borrow for something important, which will help you do your job better, which will enhance your income. But you have to really decide among, you have to make a choice. You have to make a choice that is it going to really enhance your income? Is it going to enhance your productivity? Or is it a consumption? When you, for example, buying a car which will help you do your job well, and borrowing that money, borrowing to buy that car, there might be a case for it. But borrowing money to buy the second car, which will actually make you look better in other people's eyes, or your own aspiration, that might be wasteful. So you have to make a judgment, you have to make a case, and you have to see that easy credit actually tempts us. You go and buy a large consumption, spend on a large consumption, and then nobody is looking at the worth of that money. Everybody looks at, okay, this is 45,000 rupees per month. This is 7,000 rupees per month. No, it's not 7,000 rupees per month. You have to look at what will be the worth of this money at your retirement. And so you have to really prioritize. Then, when we are young, we are very confident and we don't think of emergencies. And the kind of situation we have been through since March, it is a reminder that we should be prepared for emergencies. For a small emergency, you should not have to really go to somebody else for a financial help. Make it a priority, because these are the foundations. If you don't have the foundations, you will keep falling into difficult, into some trouble or the other. Then, small thing which comes to my mind is that, extension of this emergency thing is completely relying on employer funded uh, health insurance. Uh, Anticipate your problem. You are the best judge in terms of health conditions of your health condition and your people in your family. And that may not be good enough, that may not be adequate, and that can disrupt the whole investment or savings plan that you have. And I think one of the biggest thing, I think I should have said it at the outset, which is procrastination, postponing our investment. We think that, we have enough time, we'll take care of it. And initially, and human conditions, situations, context is very hostile to it. Reason being, when we start, we have nothing, and we are so excited about the start of the earning cycle, and we have infinite needs, all the pent up needs in terms of the phone that you wanted to buy, the house that you wanted to, uh, all the kind of equipment, gadget, or if you are setting up a home, then you will have you need all kind of things. So we think that, okay, we have enough time, and maybe that's fine. But to my understanding, investing is more of a habit, and if you don't fall in that habit, that habit will. So my understanding is that building that habit of saving that 500 rupee, even if even if it is contributing to the emergency fund, because all the financial planning, you getting your financial security, it will never happen by listening to my talk. You have to experience it. You have to experience the decline of the market. You have to experience the compounding of your money. When you put your 500 rupee and it becomes 6,000 rupees in a year, and you realize that, okay, now you have 6,000 rupee and you never had that in the first place, and look at the return that it would have generated. Sometimes it could be disappointing. But till you do it for 3 years, 2, 3 years, you will never understand the magic of compounding. It will only look like a theoretical arithmetical exercise which we study in class 10. Uh, you have to see that, okay, now you have the money which you never had, and you will never have that money if you think in terms of, it's not a dream. It is a realistic thing which you can achieve. So I think it is all about experiencing it, and avoiding these habits at the outset can really help you being on track.
Thanks, Rain. But if you could also talk about some, bad habits, investment habits or financial habits of people who've already, just started investing or seasoned investors. What are some habits that they can focus on breaking?
I would just like to repeat that, don't don't procrastinate, don't avoid, start now. One is that, starting now, because you have to experience it. The other is, some simple things which comes to my mind is, don't wait for the month of March to make your tax saving investment. That is the time when the pressure gets built up. Your accountant says that if you don't give me the evidence, uh, I'll cut your salary. So that's one. I think there is another big problem with most Indians, particularly, the way it is being sold, which is mixing insurance and investment. Everybody has, I don't know, for some historic reason, some great belief in insurance policy, and they generally turn out to be, a mix of insurance and investment, an endowment policy or a unit policy. You don't give you, and the problem of this is that these are long-term investment commitments. They are a combination of they are not the finest investment, and they are not the finest insurance. And getting fair insurance for yourself, getting the right insurance for yourself, requires a little thinking, and it is cheap when you are buying it at a young age, when you're young. And on top of it, it costs so little. One, and the way and the approach to look at insurance is that it should be looked upon as a cost. You are buying, and it's a very important thing. In fact, in if I have to prioritize in any individual scheme of life or things, insurance comes ahead of investments before, because if you have financial dependence, because it will take you a long time to build enough net worth or financial worth when your family can be taken, will be adequately covered financially. And till you have that, you need a sizable insurance coverage, and that can be provided only by a term cover. And getting an insurance, and this is a long-term commitment. So the moment you get, so you get the worst of two the moment you try and combine it, and it's a long-term commitment. And the exit routes, exit mechanism is not very simple, and it is very difficult to evaluate what you gave and what you, and it is also, very disappointing, because somebody acting in belief, in faith, and keeps investing for 5 years, 10 years, 15 years, and 20 years, and then he gets nothing meaningful, because they are many a time they are barely able to match inflation, or give little more than inflation, and you did not, people are very unclear. So don't mix insurance and investment. Many a times, people don't get opportunity to save beyond what is the mandatory PF contribution. And Provident Fund, whether it, of course, now for government employees, Provident Fund also has a reasonably modest element of equity, and even in employee Provident Fund. But dominantly, they are fixed income. So, for most Indians, the whole experience of making their longest investment in their life turns out to be substantially invested in fixed income through their provident fund. And if you can't save anything more than that, then it never does magic, because the magic of savings and investment is that you accumulate and your money compounds, and it compounds at higher rate than the inflation, higher rate than fixed income. So uh, and you can do it by investing in equity, but you can do it only when you have a long period of time in hand. And that is a problem. When you have provident fund money getting substantially into fixed income, and you have no other savings avenue, or you are unable to save any further,
Mhm.
so your experience is disappointing. So my sense is that, start a small contribution, somehow save little more than beyond the provident fund contribution. Many people think that things will be taken care of over a long period of time anyway, or by itself. It won't. Not investing in equity. This is something about which, we have heard about all kind of stories, that it is a gambler's den, and investing in equity is something where, it's a recipe of disaster. It will be a calamity. It doesn't, not really. If you are methodical, and if you follow some principle, and if you are not speculating, and if you have the long-term orientation. So I've listed quite a few of them, but they're very easy to do. Do a SIP in an equity fund, and don't wait for finding the best equity fund. Even if you get with not so best equity fund, I'm sure that, many of the very long-term poor performing mutual funds have also been able to beat fixed income and inflation by a modest margin, if not by a wide margin. And if you can't figure out anything, invest in an index fund. But, important thing is to have that promising investment and be methodical about it. Never try to time the market. Be methodical about it. Be a regular investor, and make sure that you're investing the money without the short-term expectation. Think of, 5 years, 10 years money which is going there. So if you do these 3-4 things, these I think, and the market will be very hostile, in the sense that every time you will be tempted to invest in a manner which is not in your best interest. It's not the best way to go about it. So if you follow this principle, I think, 5 to 10 years time, you will find that it has made an impact.
Thanks, Darren, for sharing these 10 points. I'm sure our viewers will find them helpful. And we now move on to the questions that we've received. And the first one is from Amlan Basak. And he says, I have a habit of investing in too many funds of the same category as I'm too conservative. But what's wrong with this if I can easily manage tracking all of them?
Yes, you are not alone. I was like this in 1990, but, in 1990 there were no open-end funds. You could not do SIPs. You can only invest in some closed-end fund as and when they as and when they were launched. Uh, I don't think there's any fundamental problem, except that, when you have too many funds, uh, you are less interested. You don't track them. Even if, of course, you can track all of them. Value such online tricks, you track them very with great convenience. You don't even have to input your transaction. Just get your account statement. Just put your mail ID for which you use for help, making your investment, and you get your account statement. Just forward it to a mail, and all your transaction history of the last 4, 5, 10 years will be uploaded. You don't have to do anything. It looks quite magical. At least I find it very magical, because earlier I used to put each and every transaction in the portfolio, my investment, the portfolio manager. uh, it's not difficult to track anymore. I think it is managing your own. If you have something sizable in something, then you are interested. That's one. The other benefit of having few fund is that uh, you have absolutely no advantage of having too many funds. If you have, 5, 6 multi-cap fund, 4, 5 mid-cap fund, some fund which was doing well at some point, and you have some small cap fund and few tax saving fund. Let me just give you an interesting information. I was analyzing the number of people, millions of people who maintain their portfolio at Value Search Online. The average number of funds, mutual fund, the count of fund held by an individual investor exceeds about 25. I'm not very precise with the number, but it was somewhere between 25 and 30. So I think it's a useless exercise, because when you are investing in an actively managed fund, you are paying a management fee, and you are paying a management fee for beating the market. And when you invest in 25, 30 funds, you end up being an index fund at the fundamental level, because one, 30, 40, 50% of the stocks in all your different funds will be the same. The alpha, or the extra return over the risk assumed by a fund manager to generate superior return for you, is lost. And the interest bit, which I was saying, that if you have 30 funds or 25 funds or 20 funds, you have 5% or 4% or 3% money in an individual. When it does poorly, you think that, oh, not much money is there. If it does very well, then it has no meaningful impact. 5% or 10% of your money does exceedingly well, and then only 10% of your money has done exceedingly well. So there could be a reward, and then the whole objective of long-term investing should be to have convenience, have superior performance, and uh, getting and paying your money, getting for your what you pay for your money is worth. So my sense is that when you are interested, you take actions. A prolonged poor performance will prompt you to do something. A great performance, you'll be pleased, but you can carry on. And so my sense is that having too many funds adds no value, and having too many funds, it actually distracts you from acting when your investments do very poorly.
Now, Jagdish Karangia, he writes in and says, you generally advise investing in one or two multi-cap funds for equity exposure. Likewise, for
Mhm.
fixed income, is it a good choice to choose one or two dynamic bond funds for a horizon of 3 to 5 years?
Ideally, yes, if dynamic bond funds would have created a case for themselves. Dynamic bond funds are the equivalent of a multi-cap fund in equities. These are debt funds which can invest anywhere, any segment, depending, and they will not be constrained by the maturity or credit quality. They will try to maximize or optimize the return on fixed income. But many of these funds have not been able to build a great case for themselves over a long period of time. That's why. And your fixed and our risk tolerance, or our behavior, or our expectation from a fixed income fund is that it should not disappoint us substantially at any time. And they can disappoint, because many of these funds actually they think themselves as an opportunistic debt fund. They don't think in terms of providing a consistent return. That is my understanding why these dynamic bond funds have not been able to build a great case for themselves, or an impressive case for themselves, despite having all the flexibility of investing anywhere they want to in the fixed income arena. So uh, I would say that are on the side, and our behavior itself is not very nice in terms of we want our debt funds to be doing well all the time, because we have decided not to take great equity risk. So my sense will be that are on the side of caution, get into a longer medium maturity or a small short maturity fund for 3 to 5 years. You will not be disappointed, because in a debt fund, when our 10 rupee becomes 950, it is a calamity. In equity, we are able to withstand that. And so I would say that no, match it with your investment time frame, the appropriate category, maybe the lower lower category and settle with it. And the difference at the fixed income, because the role of a fixed income fund in an investor's portfolio is primarily to provide stability to your overall portfolio. If you have 1 lakh rupee invested, or if you have 50 lakh rupees invested, or a crore of rupees invested, a third of your money in fixed income fund will provide the stability against a massive, calamity in the equity market. A third of your money will be relatively stable. In the worst of situation, debt funds will not crumble the way equity does sometimes. So it provides you the stability and expect modest return, no more, nothing else. Yeah.
Okay. So the next question here is from Jayan Machingal, and he says, I see money market funds returning around 7 to 7.5% consistently for some time now. Are they safe, and will they continue to generate such returns?
I hope so. And many of the well-performing funds, they are also very high on credit quality. And these returns will come down. These returns will come down simply because interest rates have come down, and what we see in the past is actually more of a benefit on account of the decline, or some of them locking into higher yielding papers. These returns will come down, but it will not. It will be higher than liquid funds and ultra short term debt funds.
KK Lavanya asks, what are the risk factors involved in investing through a PMS? Which one is better between mutual funds and a PMS for someone with rupees 50 lakh?
I would say that if you have 50 lakh rupees and that's all that you have, you should not invest in PMS, because PMS requires all that 50 lakh rupees to be invested at one go. PMS is not as tightly regulated as mutual funds are. PMS claims of performance may not be verifiable as mutual fund, because mutual funds calculate their NAV, your money gets pooled, and the NAV is disclosed every evening. And you can come and look at value research online by 10:30, 11. Everybody is able to look at their performance, their portfolio performance. As compared to that, the PMS is lightly regulated as compared to mutual fund. The minimum that you can, and you can't do SIP in PMS if you just have 50 lakh rupees. The fund manager will try to, stagger your investments if you are interested in. So PMS is not, and also there is a tax disadvantage. One is that if you invest in a mutual fund and you hold it for 1 year, all your gains become long-term capital gains, and all the gains are subject to long-term capital gains tax of 10%. In case of PMS, you are giving a power of attorney, or you are giving an authority to somebody to act on your behalf. So all the underlying transactions will be treated accordingly, accounting-wise and for tax purpose. So if your PMS manager is buying something and sells something within 1 year, it will be liable for short-term capital gains tax of 15%, as compared to a mutual fund. If you invest in a mutual fund and if you hold it for 5 years, 10 years, you don't have to pay anything, even if your fund manager is buying or selling every day 30% of your money, or in a year's time 30-40% of your money is getting churned, but you are not liable for any capital gains tax, because you are liable for taxes only when you sell your investment. So one is the tax efficiency, the other is the transparency, the third is the intensity of regulations, verifiability of performance claims, and also, and the verify. And I'm not saying that there may not be a good portfolio manager. There will be, there are, but the verifiability bit and their ability to replicate, and and I think the cost thing. When you invest in a direct plan of a mutual fund, you simply have the benefit of scale. The whole pricing or the expense structure of a mutual fund is that as a fund gets bigger, it gets cheaper. I also feel that the resources deployed for managing a mutual fund, or the compliance bit to comply with the regulatory, strictures around them, all that they can do and all that they can't, that itself makes me feel much more comfortable. So for most individual investors, I would say that mutual fund is a better bet for a variety of reasons.
So the next question is from Bal Mukund Joshi, and he asks, should we exit pure value funds as they don't seem to be picking up?
Yeah, they have turned out to be a very big test of patience for most investors. They have been extremely disappointing, and some of them are beginning to look up. But they have done so poorly over such a long period of time and they have such high quality portfolio, and they have retained their character of remaining a value focused portfolio. So I would say that if it is 20-25% of your portfolio, hold on. You have done all the waiting. Maybe something more might be right around the corner. Something will happen. And I don't have a clear premise for this, but the only premise I have is that there is always a reversion to mean. Things turn around when you least expect it, and it has. And if the underlying portfolio, I find there are some companies, such great companies, they have a long-term track record, but simply because they're yielding, they're so high on the dividend yield. The public sector have been out of favor for so long. Many of the circumstances or context has changed in terms of the reason why they have actually not done well. Some of those reasons might have diminished, or they have come down to a point where there could be an imminent turnaround. I don't know when it will happen, but I think one should have there, because most of us are chasing the winners, and the losers in the market, which are not bad. They're very high quality companies, but they turn out to be losers in the marketplace. They will, every dog has its day. Based on that belief, have a part of your allocation there.
All right. The next question is from Raja Babu Bura, and he asks, being a railway employee, I have been provided with a lot of medical facilities. Is it still important to buy an independent health insurance policy?
No, if you are confident that you'll be taken care of and it is adequate enough, you don't need to.
All right. Now, Sushant Sindhwani writes, I want to invest rupees 30,000 to 50,000 every month in order to generate a sustainable monthly income after 8 to 10 years. Please guide me.
After 8 to 10 years, invest as much. If you're getting started, save as much as you can, invest as much as in equity, and once the amount becomes something meaningful, 10, 15, 20 lakh rupees, because right now there is no point doing an asset allocation. You have nothing to guard yourself against. You haven't started. If that is the case, once the amount becomes meaningful, increase your allocation. Maybe 6th year onward, if it is 8 to 10 years, 6th year onward, maybe start increasing your, moving 10% of your money every year to fixed income till it actually becomes 30-40%. For 3-4 years, keep doing that. So you will actually be able to build an allocation to fixed income to provide stability once you have accumulated some meaningful amount. And initial years, invest as much as in equity, and 1 or 2 multi-cap funds will do the job. And if you have, a small part has to be invested in tax saving funds to get you that tax break under Section 80C up to 1.5 lakh rupees. Do that, because tax save is money earned. So beyond that, invest in multi-cap fund for next 5-6 years. Then move a part of your money to fixed income to the tune of 40% gradually over the next 3-4 years. It will also achieve stability.
So we have one last question. This one's from Nirmalya Biswas, and she writes, I'm 59 and will be retiring in November 2021. I am employed in government service and will get a pension of about rupees 46,000 every month. And I will also have a retirement corpus of around rupees 36 lakh. Where and how should I invest this money?
It entirely depends. Nirmalaya, you are very lucky. You will get a pension, and you will get a pension which will also be inflation adjusted. Now, where you should invest will entirely depend on whether this 46,000, which will be revised periodically, because government employees also get inflation adjustment because of the DA, which is announced periodically, which is matching the inflation. If it is going to be good enough for you to support your income requirement today for a living, then the money that you will get, which is 36 lakh rupees, can be invested for the long term. It will leave a larger stake for your family. And if you need some small part of your money to be invested, if you need some extra income every month, if 46,000 rupees will not be enough, then you need to invest a little differently. And I would say that based on that, I can give you a plan. So invest a little bit, anyway, in your retirement, you should be investing conservatively. You have a substantial amount of money. Assuming that, the plan one, 46,000 is good enough, and you have to invest it so that it grows, and once in a while you can withdraw a part of it. Invest in a aggressive hybrid fund and spread this money over the next 18 months. 3 years. It's a very substantial amount of money in relation to your income today, or it will be in relation to your income post retirement. So the 36 lakh rupees that you'll get, maybe do a SIP of 1 lakh rupees in two aggressive hybrid fund, and that way, 1 lakh rupee means 50,000 each in two funds, and spread it over the next 3 years after post retirement. You will be able to average your investment. You will reduce the risk of catching a market high. You will be able to achieve a relatively conservative or relatively stable equity portfolio. These funds are two-thirds or three-fourths in equity, 25% in fixed income. They will not crumble when the market gets into a tailspin, and they will be able to moderately, or modestly participate in a rising equity market. You don't have to worry about rebalancing. So these are the benefits. And once you are doing that, don't look at the investments every day for the first 1 or 2 years. That could really, cause anxiety. So that's the plan that I have, and that I will suggest if you are investing for the long run and you don't need income. If you need income, then a small part of your money should be invested in, something which is, because you are in a government service, you have not been used to or no experience of investing in equity. In that case, depending on the supplementary income that you require, you can invest. The first step of that fixed income investment could be senior citizen savings scheme, and then remaining money which you don't need to derive income from, that should be invested the way I suggested earlier.
All right. Thanks, Dhiren. So that was our last question, and thank you so much for answering all the questions our viewers have sent us.
Thank you.
All right, to all our viewers, thank you so much for tuning in, and goodbye for now.